Howdy, Jacob here. Today we're looking at National Vision Holdings, ticker symbol I. That's interesting. I wonder what they do. The company operates in two segments owned and host Legacy. It offers eyeglasses and contact lenses and optical accessory products, providing eye exams throughout America's Best, Eyeglass World, and Vista Optical. I guess there was two more, Fred Meyer and Vista Optical Military, as well as Vision Center branded stores, headquartered in Duluth, Georgia, founded in 1990. Okay, very interesting. Revenue growth is over double what it was 10 years ago. So they did see some massive revenue growth, but the last 2 years have slowed down quite a bit. Still very impressive, honestly. Gross margin, however, it's pretty consistent. I can't say it's been going down. So gross margin in the 50 to 60% range. Operating margin had been going up somewhat consistently to 2021. And then the last 2 years looks like probably sales general and admin has been hitting them pretty hard. Paying their employees better from inflation is likely the cause of that. Let's see. Income statement. Sales general and admin have jumped up quite a bit. I guess cost of goods sold have too. Inflation does that. So demand for their products have kind of slowed down over the last couple of years, but their growth in expenses has not slowed down as much. And so that is hitting the bottom line, which we can see from sales general and admin going up 91 million over the last 2 years, cost of goods sold going up almost 100 million, and revenue going up only 100 million. So that's going to really affect that operating profit. And we do see that here. Looks like there was also a write off here, though. So the negative net income is not as bad as what it looks like. So it looks like if it was just net interest, it would have still been positive, even with the income taxes that would have incurred. But looks like they're writing off an asset. So let's see whether we see that here. So we do see a write-off of goodwill. And outside of that, balance sheet shows 150 million cash on hand, 10 million short-term debt, 450 million long-term debt. They've had some debt in the past. It is down from 739 million in 2015, however. So the last 8 years, they have brought debt down a good amount, but they're still looking at over 300 million of net debt. So let's say about 400 million, and their free cash flow kind of all over the place. Historically, as high as 150 million, which would have made that debt figure not look too bad, but more recently, well below that. And so I don't feel fantastic about that debt. I do like that they have 150 million in cash on hand, though. So the debt that's likely due in a year or two, hopefully their debt of 450 million is spread out a little bit, or due a long time in the future. But if they do have some more near-term debt, they have a good amount of liquidity on hand to be able to settle that. And so I'm not horrified by that debt, but it would be something that I'd absolutely want to keep an eye on for sure. So good amount of CapEx and cash from operations, a little bit higher more recently. But I mean, it's not so much higher that, if demand gets hit even more, I could see free cash flow go negative. So that could be a big problem. Use of cash, debt reduction is big, share purchases is big. I think that's enough to get me to make some assumptions here. Based on what I'm seeing, I would want to get this pretty cheap. And so I'm not going to make horrendously cheap assumptions, but I'm not going to be frothy either. And so with a good amount of capital allocation, especially based on these margins getting hit as hard as they are, I'm going to say debt reduction is majority of that capital allocation. And so let's say 5% revenue growth. I think that's even too much. 4% for margins. They've been getting hit hard. Let's do 3 and 2.5, or let's split that 2.5 and 3. Share change 1% is about 9 million. I think that maybe they'll use 9 million or so for share repurchases, but it's going to get offset even more by stock-based compensation. PE, I mean, I don't know, 12. I don't want to get this for market average. I want to get it for lower. And so, I mean, again, I could be being too conservative here, but this is a company that I'm going to want to get pretty cheap. The businesses that can grow 7 to 15% a year in revenue and can become more efficient, increase those margins, those are companies that I would be more willing to buy at a price that appears more expensive. Something like this, where I'm a little bit skeptical. Revenue's definitely been hit kind of hard. Expenses are growing a lot more than revenue the last couple of years. This is going to be something I'd want to be a bit more conservative on and get it at a price that is definitely cheap to me. Um, and so right now, it's definitely not there. Hope you enjoy this video still. Have a great rest of your day.